So I have here a letter sent to the Dallas Fed this morning and was posted on their first quarter weekly survey. This letter is from a publicly traded exploration and production company in the United States. That's an oil company. Publicly traded means it's a good size oil company. And I will read it to you. The key word to describe 2025 so far is uncertainty. And as a public company, our investors hate uncertainty. This has led to a marked increase in the implied cost of our capital of our business, with public energy stocks down significantly more than oil prices over the last 2 months. The uncertainty is being caused by the conflicting damages coming from the new administration. There cannot be U.S. energy dominance and $50 per barrel oil. Those two statements are contradictory. At $50 per barrel oil, we will see U.S. oil production start to decline immediately and likely significantly, 1 million barrels per day plus within a couple of quarters. This is not energy dominance. The U.S. oil cost curve is in a different place than it was 5 years ago. $70 per barrel is the new $50 per barrel. First, trade and tariff uncertainty are making planning difficult. Second, I urge the administration to engage with U.S. steel executives to boost domestic production and introduce new steel specs. This will help lower domestic steel prices, which have risen over 30% in 1 month in anticipation of tariffs. The administration's chaos is a disaster for the commodity markets. Drill baby drill is nothing short of a myth and a populist rallying cry. Tariff policy is impossible for us to predict and doesn't have a clear goal. We want more stability. The disconnection of oil and natural gas markets, specifically commodity pricing, seems to be causing a feast or famine effect on the industry. Companies with natural gas weighted assets will spend more money in 2025 developing those assets, but oil weighted companies will decrease capital spending with the current pressure on oil pricing for 2025. The administration's tariffs immediately increase the cost of our casing and tubulars by 25%, even though inventory costs our pipe brokers less. U.S. tubular manufacturers immediately raise their prices to reflect the anticipated tariffs on steel. The threat of $50 oil prices by this administration has caused our firm to reduce its 2025 and 2026 capital expenditures. Drill baby drill does not work with $50 per barrel oil. Rigs will get dropped, employment in the industry will decrease, and U.S. oil production will decline as it did during COVID-19. I have never felt more uncertainty about our business in my entire 40-plus year career. Uncertainty around everything has sharply risen during the past quarter. Planning for new development is extremely difficult right now due to the uncertainty around steel-based products. Oil prices feel incredibly unstable, and it's hard to gauge whether prices will be in the 50s or the 70s. Combined, our ability to plan operations for any meaningful amount of time in the future has been severely diminished. The only certainty right now is uncertainty. With that in mind, we are approaching this economic cycle with heightened capital discipline and a focus on long-term resilience. I don't believe the tariffs will have a significant effect on drilling and completion plans for 2025, although I would imagine most managers are developing contingency plans for the potential effects of deals, i.e. Russia, Ukraine, Gaza, Israel, Iran, on global crude and natural gas flows. Now, these contingency plans probably have more downside price risk baked in than initial drilling plans did for 2025. Thanks.